The whole life in general, it's been around for over 200 years. But index universal life and variable universal life, these IULs and VULs, they've only been around since the 80s. There's not the history that's behind them. In fact, banks themselves don't use universal life in any capacity to secure their tier one capital. They use whole life.
Many financial advisors and insurance agents push IUL as a superior option for infinite banking. But they either don't understand the strategy or they're just chasing commissions. And here's what most IUL policy holders don't realize. IUL policies are tied to the stock market's performance, meaning they lack guarantees, lack guaranteed cash value, guaranteed growth. The cost of insurance in IUL increases over time, draining your cash value. Most IUL policies have participation rates and caps that limit growth, making them unpredictable and making them out of your control. And a poorly structured IUL policy can completely fail, leaving you with no banking system at all. So if you want infinite banking to work, whole life is your only option. This is what we're going to dive into deeply today. This whole episode is about the pain that I've seen from people who have purchased IULs and why, as a Nelson Nash certified infinite banking practitioner, which both Jeremy and I are, we will never, ever use an IUL to help someone set up their infinite banking strategy.
Yeah, that's because IULs can literally destroy your entire banking strategy, right? So a couple of things that you really hit on there. With IULs, your returns, they're capped. You don't have the guarantees that you have with infinite banking. And quite frankly, there's a lot of myths that are out there that you can build infinite banking with IUL. But when you tie that IUL strategy to a market, you give up the guarantees that infinite banking, whole life, actually provides. I keep using them almost synonymously because of the way that you and I design the policies, but we only use whole life, do we not?
Yes, only boring, old, permanent whole life insurance, and only working with companies that have been profitable for at least 119 years or more consecutively.
Yeah. And that number keeps growing year after year. And it's amazing what these companies have been able to do for such a long period of time. For the infinite banking, actually, whole life in general, it's been around for over 200 years. But index universal life and variable universal life, these IULs and VULs, they've only been around since the 80s. There's not the history that's behind them. In fact, banks themselves don't use universal life in any capacity to secure their tier one capital. They use whole life. In fact,
And wait, pause there though. Why people have to understand, like we're jumping into, bigger words, things if you're not financially someone that's studying finances and someone that's really knows the lingo, like that's a buzzword. Tier one capital. What's tier one capital, Jay?
it's the safest form of capital that banks can have. It is their most liquid, safe form of capital.
And it's required.
It is required.
It's required. It is the money that kind of backs up the whole system. It is their safe money, their guaranteed money. And they only have, oh, I don't know, at least $225 billion in permanent life insurance. And we're telling you here, right in our WealthWise Banking podcast, they do not have IULs. They do not have ULs, do not have VULs. They don't have anything with a UL chassis because it's tied to the market. And the market inherently is risky.
Right. Now, that's not being said you can't use whole life to invest in the market. You can, but you do it through policy loans. You don't actually tie the asset itself to an index, and that's what index universal life is. It's tying it to a market index. So, a couple of pitfalls for using IULs for infinite banking is the lack of guaranteed cash value growth. A fundamental principle of infinite banking is the guaranteed uninterrupted compound growth. With whole life insurance, you have guarantees. That cash value is going to grow every single year. It doesn't matter what the stock market's doing, the real estate market, crypto, whatever your fancy is. Whole life has a guaranteed growth pattern in it because it is a contract. So long as you, the owner, fulfills your obligation, which are your premium deposits,
Yes.
you're going to have guaranteed growth from the insurance company. And why do I like that? Well, the company's been around, like you said, for over 100 years, performing, giving dividends, while not guaranteed, a dividend every single year. Think of all the wars, the pandemics, the market crashes, and all the cycles. you're getting every single year.
Either being on the gold standard, coming off the gold standard, having your money become fiat money, not tied to anything, like all of the different things, these companies remain profitable every single year. It's kind of funny, Jeremy. I looked into other companies that have been profitable for this long, and you pretty much only find breweries.
Really?
Yes. I thought that was pretty interesting. Over 100 years, I guess that kind of ties to our human nature.
Hmm.
But with, we're being fun, but with IULs, with what we're talking about, if you want a strong foundation, how do you want to build it? Do you want to build it on something that's been tried and true and tested over generations? Over generations, multiple generations, over decades and centuries, not just since before, I mean, after I was born, before this guy was born, but after I was born, as far as IULs and index universal life. You're not hearing people telling you, hey, banks own billions of dollars of IULs.
No, you're not. And when you use an IUL to try and build an IBC policy, I put that in air quotes for our podcast listeners out there, you have market volatility. That market volatility equals uncertain growth.
Yes.
If the market underperforms, guess what? Your IUL policy may also earn little to no interest. But hey, wait, Jeremy, I'm an insurance agent and I do IULs all the time. We have a floor.
Yes, we do.
We have a floor. What does that mean, Jason?
The floor means it can never go below zero, Jared,
Below zero.
or whatever number they set it at.
Yeah, but zero is not a
You
hero.
know what? I heard someone try to tell me that the floor was set at 6 the other day.
Okay.
Exactly. Exactly. We'll just move on. But I'm just telling you, people are going to tell you crazy stuff. You have a floor so you can never lose money. That sounds pretty good, right?
Right. But like I said, zero is not hero. If you have 0%,
I've never heard you say that.
so if you have 0% and you're not earning anything for a year, well, what was the opportunity cost of that? Not to mention getting into one of the other common pitfalls, the fees. You can earn 0%, but as the cost of insurance keeps going up, you actually had negative returns.
But why does the cost of insurance go up, Jeremy? Because one of the guarantees with whole life is that your premium deposit is always going to be the same.
Mhm.
It's guaranteed. And it even has a safety net base for you the way that we design them.
Absolutely.
But why is the insurance cost going up in an IUL?
Well, with an IUL, you have basically continuously renewable term insurance. So as you get older every year, the cost of insurance goes up. So one of the pitfalls.
Why does that happen? And we're just trying to break it down, make it super simple, because there's a lot of people, there's a lot of other infinite banking practitioners in my mind that really dive in and will pull apart the UL contracts. But if you just think in logic, if you think in terms of logic and what sounds true and what feels true, like the reason insurance gets more expensive as you get older is because you're gonna die and you're closer to dying, right?
Yeah.
Like me and Jeremy at equal health and the same rating, I will have less death benefit than Jeremy. Why? Because I'm closer to the age where I'm actually on the actuarial table going to die.
Yeah.
And so my insurance gets more and more expensive. So to have the same amount of insurance as Jeremy, mine would cost more than his would.
As an airline pilot, I like to give an analogy. I have more runway left.
Yes. I use quarters of football. I always say, hey, you know what? Jeremy might be almost at halftime. I'm at least at halftime or almost getting ready to run out of the locker room and get into the third quarter.
So what's the problem with this? With unpredictable costs, you may start with low premiums, but as you age, your insurance costs are going to increase at a time, like you say, with less runway available, a time when you probably need that death benefit most.
Yes, when you need that the most, and when perhaps you're actually making less because you're starting to come down the mountain and wind down.
Well, here's another issue with it too. As you get older and that policy gets more and more expensive, where does the cost of the insurance come from? It can come from the cash value itself. And if you don't have enough cash value because one, you tied it to an index, you had the 0% floor for a number of years, or a market correction or crash that totally tanked your policy.
Hmm.
Well, now you don't have the cash value to pay that cost of insurance. So what do you run the risk of? Lapsing the policy. You lost your entire banking system at a time when you truly need it.
And you lost the piece of legacy that you set it up for as well. Because I'm sure that, everyone that's listening to us is doing this because you love someone or you love something and you're trying to interrupt patterns that you've had in your family before. Maybe you are the leader, you're the first to start like Jeremy and I are for our families. You're the trendsetter. And people are going to tell you, hey, and I've had hundreds of these conversations, and I promised Jeremy that I wasn't going to go on any tangents today or go to tangential. I used to be IUL agnostic. I used to think, yeah, hey, whatever you set it up for, I'm sure that you knew what you were doing. You understood that, hey, this is going to solve this problem. Maybe, some are tied to like a long-term care plan. Maybe there's some other thing you're doing. But if you're doing it for banking, I can tell you, I have talked to at least 100, if not a couple hundred people who are in IULs that thought they were set up one way, that aren't working the way they thought they were set up, that do not have the cash value, that have giant surrender fees. And I had a guy yesterday literally replace his IUL with a convertible term so he can convert it into a whole life policy down the road because he's going to lose thousands of dollars because of the surrender charge.
So what are surrender charges?
You know what? I think it's kind of like a prison handcuffs, Jeremy, where you have your cash value of your policy that you've built with this IUL. And then within, I think it's 10 years, if you try to get out of the contract before 10 years, you actually got to pay a fee to the company to leave.
That's right, because there are hidden fees, there are administrative charges, there's the cost of insurance. IULs are just riddled with fees. And what do we talk about the big wealth destroyers, right? You have interest, you have taxes, and you have fees.
Yes.
You can't build a banking system when you're constantly getting feed to death.
And when you're doing this, when you're telling people, hey, this is going to work for banking, you got this great upside, you're always going to be sold the upside. Well, guess what? The market's been a little bit volatile lately, hasn't it?
Well, the market's always volatile. We don't control the market.
No, we don't control the market. And so you're hearing variability. You're hearing that you're not in control of the contract. That's what we're telling you. Like when we set up someone as a Nelson Nash certified practitioner, we are not allowed to use an IUL to set up a banking policy. Like Jeremy doesn't remember this, but I'm pretty sure I signed something that said I would not do that. I would not do that. And I thought about that a lot. I'm like, why would the Nelson Nash Institute say it? Well, because we're supposed to be in service. We are helping people take back control of their money. We're bringing banking back to the you and me level. We're making this country great again by taking inflation out of the banking system.
Hmm.
But if you're tied to something that's volatile, I'm getting a little heated, man. Like if you're tied to something that's volatile, if you're tied to something that, has fees that are hidden and has a surrender charge, that sounds like handcuffs. If you can have your contract, the upside turned down and the contribution rate turned down because the company wasn't profitable, well, again, that doesn't sound like you're in control.
You gave up. You're the borrower, right? You're not the builder.
No.
You're giving back control, the banking function of your life. You're giving control back to someone else. But they always talk about these market upsides, but what they don't talk about are the participation rates or the cap rates.
That's what I was just saying. That's the contracting that's owned and controlled by the insurance company.
Yeah. So the participation rate, if you have, let's say, growth of 10% in the stock market for that index that year,
Yes.
but your participation rate is 80%, you're only going to get 8%. Where the cap rate, as another example, let's say that you have a cap rate of 9%.
Hmm.
And even if the index gains 15%, you're not going to receive more than 9%. So even on the thing that they're saying, this is why we do index universal life, they're still placing limits on you. They're still handcuffing you, like you say.
Yes. And there's a guy you guys should look up. His name's Bobby Samuelson. Have you seen him speak before?
No, I haven't.
Check him out. He is someone who is putting out tons of information, both IULs, whole lives, and he's digging into this all the time. He talks about, I watched him do this fascinating presentation, and he wasn't even saying IULs are bad, but he said basically the way that they're built, the index is built, Jeremy, is, and we didn't talk about this prior, so he said that they go and find a bunch of Ivy Leaguers, they sit them in a little dark room, they tell them to look at the market, to find a place in the market where if they had the index there, it would project and illustrate really well. And then they run the projection backwards 10 years.
Hmm.
They are built on a hypothetical, which is why, the laws keep stepping in and saying, hey, you can't illustrate it like this. Like that's happened several times in the last couple of years where they said, oh, no, you can't illustrate it at this cap rate, at this percentage. And they keep coming down, but they always seem to remain like a percentage or a percentage and a half higher than what a permanent, boring old whole life would illustrate it. Because they're trying to sell the possibility. We all want something for free. I get it. We all want something that's too good to be true. We all want our cake and we want to eat it too. But when you understand how they were built and how the illustrations were built, like look, if you want to see more that they're selling you something, IUL illustrations are colorful. They have different things. If you're going to pass away, your family gets this. If this, if this. They look nice from like someone that has an art background. Like, man, I want that one. I don't want the one that's black and white and boring that's 20 to 24 or 26 pages of numbers. But what I'm talking about is you're being sold.
You are.
And you're being sold something that pays someone 140% more or 40% more than what even the top commission would be for that person.
And that's I think one of the leading reasons why so many insurance agents, the Jakes from State Farm, build these policies. Because they're getting paid on these IULs. And guess who's not getting paid? The policy owner. The person who's trying to build the banking system on the hopes and dreams. That money isn't going to them. It's going to the insurance agent.
Yes, and I have a friend who I helped set up her first. I'm not going to say her name, but she's very, very well known. I helped her set up her first permanent whole life, specially engineered policy with a mutually owned company. And now she has 5. She also has what? She has 5 IULs that she set up for her and her daughters, and she hasn't let any of them go or 1035 them because the surrender charge,
Mm.
because of the handcuffs, because she doesn't want to, she has this sunk cost bias that she doesn't want to lose the money. I keep telling her, just pay the dummy tax, be done with it, move on.
Yeah. So why do we like whole life? Well, whole life is going to give you guaranteed returns. It's predictable over time. There are no participation rates, no cap rates. There's no administrative charges, and it's more accessible. You have more access to your money at a guaranteed time, especially as you age. The guarantees that you'll have there to either supplement or offset retirement. But more importantly, it's the death benefit too when you're older. When you talk about the legacy planning behind it,
Mhm.
you know for certain that that death benefit will pass to your heirs tax free, bypass probate, and it's going to get paid out immediately, right? That's powerful.
Absolutely. And if you think about just the word guaranteed, who likes guarantees here? Anybody, Jeremy?
I think guarantees are sexy.
Guarantees are super sexy. Woo! Get a little heated around here, right? So you got the guarantee that your premium deposit is always going to remain the same. You have the guaranteed growth rate of the contract. It'll never do worse than X, like depending on the company. It can be anywhere from 2 to 3.75% for the mutually companies that support IBC. And it's going to be a guaranteed death benefit that Jeremy was just talking about. Like you have those 3 guarantees. And oh, by the way, we can't say this is guaranteed, but they've never missed a dividend payment. So your money is more likely or most likely growing at like 5 to 6% every year, compounding uninterrupted with no volatility, no downside, no years. What happens, Jeremy, if you're in the market and your year goes to 0 to try to catch up and have that cash value of what you would have at 6%? It's going to take a while.
Yeah. If you take, what is it, a 20% hit, it's like a 50% return to break even or something like that.
Yeah, it's almost double of whatever the hit was to get back to where you were, just to get back to where you were.
Because you have to make up that ground
And
to
then
get there.
and then if the company, I mean, we're just doing hypotheticals for the moment, but then if the company says a cap, you say it's 15%, the market did that index, but they capped you at 8 and they turned your participation down to 50, well, then you got a 4. You know what I mean? So that's all unknowns to you.
Mhm.
It confuses me. If it confuses you, good. Don't do it.
Don't do it. Don't is simple. But that's why we say that whole life, practicing infinite banking with whole life should be the financial foundation. We're not saying don't go and build wealth through investments. Not at all.
No.
We're saying,
No, actually, the only way to build wealth is through investments. You have to put your money to work for you. Your money has to work while you're sleeping to build wealth.
right.
To build wealth.
And so, but this is where you can secure that principle. You get the guarantees of whole life without being subjected to volatility and fees and participation rates and cap rates and yada, 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 all that other confusing jargon. And you use it as an opportunity fund to go out and hedge against volatility. Whole life gives you the hedge against volatility.
Yes. And it's boring. Again, it's permanent life insurance. It's been around for 200 years. It's been profitable every year that it's been around. Whole life loans started in 1848. Why? I think because people probably didn't have good financial habits then either, because we don't think long term, which is not what we're talking about today. We're talking about the IULs. And so just know the first question you should ask somebody if they try to sell you something, and I'm talking about selling, not helping you, not helping you go from being a borrower to a builder. But if they're trying to sell you something, ask them, are you using this? How has this helped your life be more successful? Show me what you've done with this. Ask them those questions. There's a company that recruited me a couple of weeks ago, a guy I knew from a mastermind, and he recruited me to join. And he's like, yeah, we do IBC. And with how you build teams in the past, Sipple, you'd be a great fit. You should. I'm like, awesome. I was like, what do you guys use to build these with? He said, IULs. I'm like, have you read Nelson's book, Becoming Your Own Bagger? No, I haven't. Okay, this is a great call. But their goal is to have 100,000 agents by the end of this year
Wow.
selling IULs for infinite banking. So that's what we're up against. How many infinite banking practitioners are there that are certified?
My understanding is a little bit more than 400 between Canada and America.
So between Canada and America, there's 400. So we're going up against 100,000 people with really sexy illustrations in color, promising you the world. You guys got to know what's happening. You got to know what's up, and you have to prepare yourself because it's coming. We're going to talk to more and more people who have bought IULs. I had a guy the other day almost buy one, and for some reason, he didn't pull the trigger. It didn't feel right. And then he came back and he started a policy, a properly structured whole life insurance policy from a mutually owned company where he is applying to be an owner in that company, where he is giving away the risks to the insurance company because they're guaranteeing the three things I already talked about. The premiums stay the same, the guaranteed death benefit, the guaranteed growth, and he's only committing to continuing to pay his premiums because if he ever surrenders a policy, is there a surrender charge?
Not for whole life. No.
None. They just give you your money.
Yeah.
So all of the risk is in the insurance company. That's where you guys want the risk to be, is with the insurance company. And the only risk that you're taking on is your commitment to yourself, to paying yourself first. And if you can't do that, then you're probably not right for this anyhow.
I'm going to tell you though, I actually looking forward to 100,000 agents, kind of like the Spartan 300. You know, with my special operations background, they always say we're going to give you a mission that no one else can, perform. And guess what? You're going to sign up for another one and another one. And I'm always looking for a fight. So if there's 100,000 agents out there that want to manipulate the system and try to take advantage of our members, let's do it. Let's go to war.
Hey, I'm down with that. The reason you already scare me a little bit, Brett. And walking around my house like a robot earlier, he's like, it's easier to kill people this way.
I did not say it.
Oh, he did not say that. But he's an intimidating guy. He played rugby for fun, for God's sake. And he's a martial artist. I take martial arts just so I can stay safe around him. But no, joking aside, we do have a fight coming. You're going to see a lot of people pushing IULs, and we're ready for it. And the reason we're partners is because we're going to bring you knowledge that is going to prepare you for your future, for your kids' future, for your grandkids' future. And you're going to know what to say, how to say it, what questions to ask. And you're not going to get taken. You're going to have people that are going to help you build things that are good for you, that you're in control of, that you have guarantees with, that have been used and known and trusted and are legal for hundreds of years. So don't do an IUL.
I would do an IUL, but let's say someone did. If someone had an IUL, can you fix an IUL mistake?
You can fix an IUL by doing a like-to-like exchange. And what is that for life insurance? Tell the folks.
It's a 1035 exchange. You mentioned it earlier, but in real estate, you have 1031 exchanges. In insurance, you have a 1035 exchange, which is effectively taking the cash value from the IUL and transferring it over to the whole life policy. Now, again, you want it structured for banking. We're not structuring it for death benefit. We're using it for banking purposes. But that's how you do it. It's through a 1035 exchange. Now, there are a couple things that you want to check on.
Yes.
You mentioned earlier, surrender charges. Is it worth it doing it? And if there's no answer, there's no right answer to this. It's all individually tailored. Do you want to take the surrender charge and start over with something with guarantees? Or do you want to stick with what you have and perhaps create a brand new banking system from scratch?
Yeah. Remember, you're in the driver's seat. This is your money. This is what you worked hard for. So you get to decide that. We will guide you. We will help you look at those things. If you're thinking that that is something you want to do, the 1035, you need to go and ask the company that wrote it for an in-force illustration. So you can see what you have, see what the surrender charges are. And you also want to give them a call. This is something I've learned recently helping people 1035 policies. at times, insurance companies don't want, no one wants to give up their money.
Nobody.
Nobody wants to give up their money. So you want to make sure that they know that you're planning on surrendering it, make sure that they're going to help you do that. And it won't be easy, but you can do it.
Well, nothing worth having comes easy.
That is true.
Now, another thing you need to do is make sure you're working with a professional. Jason and I highly recommend working with an IBC practitioner. If it's not one of the two of us,
Yes.
if you don't resonate with me, guess what? There's an entire institution out there where you can
You got
the local
390 other people you can go find.
you can.
Yeah. So you can find someone that's going to be a good fit for you. And we suggest that more than anything. We've been talking a lot about who we attract and, who are ideal people to work with. They're just people like us. They're people like you guys that are listening, right? Because you're listening to us because there's a resonance of what we're telling you. If you don't want to work with us, go find someone that's an IBC certified practitioner. You just go to the Nelson Nash Institute and look them up,
Hmm.
right? Look them up. We have so many good peers. Like, I'm so excited to be able to learn from my peers this week, learn things if I'm not doing that I can get better at and see what they're doing.
Likewise. Now, because we talk to people who are like us, I would first ask the question, all right, I have a universal life policy. I want to transfer over to whole life. Are there taxes? Are there taxes on that transfer, 1035 exchange? The answer is no.
Yeah. Okay.
You do not have taxes when you transfer because it's like kind to like kind, like you said.
Yes.
You're transferring the cash value of a universal life over to a properly structured whole life. So there is no taxable event.
Yes. And you're also transferring whatever the insurance was. Like, you were insured up to a certain point. So you carry that same coverage over. Like, that's another piece of a 1035. But you also just, you want to look at what the surrender charge is, get an enforced illustration, just know all the pieces to your puzzle, I guess, or know all of different cards on the table so you can understand what is the hand you're holding. Is it something that you want to hold on to? Is it something, I got someone just get rid of it, just surrender it, take the money back, didn't exchange it, but eventually he's going to build his system through whole life, through permanent whole life, but he's starting with a convertible term because he wants a certain amount of coverage for him, his wife, and their children. He wants to make sure their coverage, he wants to make sure he can convert that, but he also wants to turn on his income, the first business first. So, like, that made the most sense for him. And I'm just using him as an example because I'm also working with someone that's upside down $1.5 million in a premium finance IUL.
Explain that one.
He puts in 200,000, the bank puts in 400,000 into his policy per year. And so he gives the collateral to the bank. He didn't realize that the rate was variable with the bank, and then his IUL is not performing.
Oh, wow.
And so he has like $1 million that he can surrender, and he has a surrender charge in that still. And he's getting charged roughly $10,000 to $12,000 a month in interest from the bank for the loan.
Who's in control of his banking system?
Well, the bank and the insurance company. So he, in both places, he has, and that's when I went to get help from some of the executives at one of the companies we work with. And they're like, well, in a perfect environment, this is a win all day long. But as soon as the rates change with the banks, as soon as the rates change and the performance changes with the IUL, you're kind of out of luck. And that's where he is right now. And so his choice is either keep doing what he's doing till he has the point where he will surrender or use it, but he's not even using it for banking. He's set up for protection.
Hmm.
But he has such a business that he wanted that 10 million plus in protection. And so he had it funded this way. He was sold the upside. He didn't understand it.
I mean,
He just asked the question.
you could build the same thing with whole life, and
Yeah.
you could add in additional riders and insurance to build out that protection piece of it.
And be in control of it the whole time.
And correct, and not surrendering control, not being a borrower, right?
Yes.
You got to take control.
And to be a builder, you have to have the knowledge, and you also have to apply. There's one thing to have knowledge, and there's another thing to apply the knowledge that you have, because you're going to learn things.
Yeah, and what good is knowledge without application of knowledge, right? So that's what wisdom is, isn't it? Wisdom is just simply the application of knowledge.
Yes, that's it. And action, taking action, which is what you're saying.
So feel like this pretty much wraps it up on the dangers of using IULs.
No, I want to talk about it some more. No, just kidding. So you will hear us mention this from time to time, but make sure that you keep pouring into your knowledge and know that unless you get on the mat, nothing's ever going to happen. So Now you are empowered with the questions to ask somebody. If someone comes to you and said, "Hey, I have this great thing that you got to do this. IULs, you got an upside, you got this, you got that, you got colorful illustrations." Make sure you say, "Hey, that's cool. Are you doing it? Show me." And then that will end that conversation really quickly. Because then you'll find out if you had someone that's a banking practitioner that's using it in their life or not.
Well, what you'll also find is a lot of these people who lead with IULs love to lead with illustrations. Illustrations are one of the last things I want to end up showing you. Why? Because I need to teach you how to take off and land before I give you the fighter jet.
Yes, thank God, because that's one of the things I love about you is that I joked around from episode one. Jeremy's good in the sheet. Me, I want to talk about the process. I want to talk about the systems. I want to talk about the logic behind this stuff. So if someone's leading with an illustration, how is that solving anything? It's a wall of numbers for you. So
You're absolutely right.
see, I told you we keep talking about it. So anyhow, now you have some questions. You are more prepared than you were 30 minutes ago or 35 minutes ago. And we are going to look forward to seeing you guys again. Thank you again for always listening, learning, and preparing yourself to be a builder where you're going to take back control of your money and bring banking back to the you and me level.
All right. Until next time.
God bless. Take care. Thanks for joining us on WealthWise Banking. If today's episode inspired you, please subscribe, leave a review, and give us a like. It's a simple way to help others discover these empowering strategies and join our community. Together, we're building a network of people who believe financial freedom is within everyone's reach. Remember, financial independence is about making every dollar work for you, one step at a time. Until next time, stay inspired, stay in control, and keep building your legacy the wise way.